This is a guest episode of Ask About Wealth, where Stephanie Wickham talks about tax planning for expats with Paul Overy. If you like this episode, you can subscribe at askaboutwealth.ie or check the show notes for more details.
Welcome to Tax Bites for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Avoid the hassle of dealing with your bank and transfer online, by app or over the phone or Currencies Direct today. Keep listening for an exclusive offer for Tax Bites for Expats listeners, and thanks to Currencies Direct for their support of this podcast.
Hello and welcome to the Ask About Wealth podcast. As regular listeners and subscribers and viewers on YouTube know, we alternate these podcasts between me pontificating away at camera all by myself and guests. And when we bring in guests, we want these guests to bring with them exactly what we're set up to do, which is new knowledge and new information for our viewers, for our listeners, that will either be beneficial to you, the listener, yourself, or indeed beneficial to somebody you might know. Today, I'm delighted to welcome Steph Wickham. Steph is a chartered tax advisor and chartered accountant and founder of Expat Taxes.ie. Steph, thanks a lot for coming along today.
Thank you so much for having us.
Delighted to have you here. And you know, while I was telling you before we were recording there that our listeners and viewers are predominantly Irish-based, there is a growing number who are overseas and therefore expats, which fits neatly into your world. And, you know, there is a growing number of people who have no affiliation to Ireland coming on our consuls, for example. I mean, in the last week, I did 16 consuls. 6 of them were from people from overseas. So there is a rising interest in exactly what you help people to do. And tell us what you specialise in, Steph.
So Irish tax is our main focus. I suppose in terms of the tax heads that we would regularly advise people on, you're looking at the common tax heads like income tax, capital gains, and then obviously capital acquisitions tax, so inheritance and gift tax. We'd have a lot of clients who have questions about, you know, how am I going to be taxed when I come back to Ireland? Can I transfer money from abroad to Ireland? You know, what do I need to do in advance of my return to be compliant in Ireland and perhaps in another jurisdiction? So our job really is to kind of take what is essentially complex tax legislation, both from an Irish and an international perspective, and simplify it and apply it for the client so that they can form a plan and get clarity on how they're going to have to pay taxes once they come back to Ireland.
Okay, and in terms of do you deal exclusively with people either leaving or coming, or do you have regular tax clients who are here forever?
Exactly. So we would have I probably say we have 3 categories of client. We've got somebody who's planning to come or recently arrived. We've got someone who's planning to leave or recently departed, and then the third category would be somebody who has ongoing tax filing obligations with an international slant. So that could look like somebody who maybe moved 3 to 4 years ago from abroad to Ireland, and their tax return in Ireland is not straightforward. It's complicated by the fact that they have foreign income or foreign gains, and maybe they have a big life event coming up like an inheritance or the sale of a foreign asset, and they need somebody to guide them through it so that they can navigate it. So broadly we would work with those 3 cohorts, but the common thread is always that there is an international element to their profile. So they either have lived abroad or are living abroad at some point.
Very good. And And you have some personal experience in this regard, isn't that right?
Yeah, so I suppose what's quite interesting is, we do consultations like you yourself mentioned you do. And it always resonates with me when I talk to clients about how stressful it can be to be living away from your place of origin. Returning there even can be difficult. We ourselves, my husband and I, lived in Australia for 8 years. So I had trained with KPMG in Dublin. We relocated, worked with KPMG in Australia, and then life happens, and we had started a family. And as we were saying before we started to record, there's this common thread that, Irish people feel the pull to come home, that desire to return at some point in their life. For us, it was when we started a family, and just memories of, the logistics of packing up a container, trying to find a rental property in Ireland, and the emotional part of saying goodbye to the friends that you'd made, and then returning to a place where life had gone on as if you had never left. In some ways, but in other ways, things had moved forward. So just reconnecting, professionally and kind of in a social setting, it's difficult. We call it coming home, but it doesn't always feel like that initially. And as time passes, then you'll find that it gets easier. So often we'll see in forums and with clients that clients are returning expats will have questions about, am I doing the right thing? And, is this going to work out? So we try to bring a sense of that when we advise our clients. In other words,
because you've been through it yourself.
Been through it. And interestingly, obviously, we are a team of 8 people. All of us have actually lived internationally at some point. So that's not one of the prerequisites to work with us, but it does help that people have a sense of, we're advising on one aspect through the lens of taxes, but just being cognizant of the fact that this is a big life event for the person that we're speaking to.
Absolutely. And before we were recording, you were telling me that's kind of broadly, leaving Ireland, as in I'm sure there's people listening to us now who have plans, if not plans, desires to go overseas. And then, of course, there's the audience that are overseas already who want to come back, the expats themselves. And then, of course, there's the cohort of people that are appearing on my consoles, which are looking to come to Ireland because their granddad was born in Ireland or something, and they may not be as happy as they once were in their current jurisdiction. But tell me, you said earlier on leaving, let's focus on leaving Ireland for a minute, and the people who are listening who are either contemplating or, planning that. You said to me, that the tax issues depend on where you go, what you're doing, what assets you leave behind. And so can you put a bit of meat on the bones of that for me?
Yeah, so I suppose if we go into a consult with a client, one of the ways I kind of open it is, to kind of ground the discussion in the non-negotiables from a tax perspective. And when you talk to somebody, you must always be very clear on their residency position, and their ordinary residency position, and their tax domicile. Those three are the 3 main pillars that underpin how Ireland seeks to tax someone. So when you're talking to somebody who's looking to leave, what are they looking for? They're looking for clarity. What's going to happen if I'm no longer here? Does Ireland have a right to tax me? And I think for the majority of people who are perhaps leaving Ireland to go and take a job abroad, and perhaps they have quite simple financial circumstance such that is their only source of income, it's relatively straightforward. You can be relatively sure that, you're severing your connection with the Irish tax system. Where it gets more complicated and warrants review is when somebody has perhaps been in Ireland for 3-4 years at least, perhaps longer. They have assets and they decide to leave Ireland and reside elsewhere. A tax residency is triggered elsewhere. So the complexity comes from the fact that Ireland has 2 tax residency concepts. The first being tax residency, which is just a day's test. Are you here for a sufficient number of days? And then a secondary concept, which is called ordinary residency. And this concept, essentially, it's quite far-reaching because it keeps you in the Irish tax system for 3 years after you leave. And people can get quite concerned about this. So our job as advisors is to work out where they're going, what their income sources are, what the potential gains are likely to be, and how this ordinary residency charge to taxation is going to impact them. Because quite interestingly, ordinary residency actually taxes people on a worldwide basis for income and gains, with some limited exceptions. So if you're talking or thinking about going abroad and you have assets, perhaps it's US listed shares, an Irish property, a foreign asset, and you're looking to go to a jurisdiction that we have a treaty with, or perhaps we don't, you really should be taking tax advice to understand, what are my obligations to Irish revenue? Now, as we were saying before we started to record, generally speaking, with the right advice and planning, this doesn't need to be a disaster. People can get quite worried about this. They think, I don't want to become an ordinary resident because it's this, enduring connection with Ireland from a tax perspective. And that doesn't have to be the case. But I think it's really just to kind of highlight the specifics of where you're going, how long you're going for, and what you have really matter. Because we will often find that clients come to us really concerned about a problem, maybe because they've done some very good research themselves, and the conversation will take a completely different turn because they haven't known the right questions to ask. And then we can guide them as to, we'll consider this, do or don't do this, and we can get to a nice conclusion.
So if I can just feed back to you what I think you've said, and correct me if I'm wrong. So living and working in Ireland, you're either resident or ordinarily resident. And that depends on the time you've been in Ireland in that sense. So for a lot of people listening, they were born, bred and buttered in Ireland. So they've been here forever. So they are ordinary resident by your definition because they've been here forever. Anybody who comes to Ireland who stays here for 3 years or longer is automatically ordinary resident, you were saying. A resident before the 3 years and ordinarily resident afterwards. And then the ordinary resident person has at least the potential to be in the crosshairs of Irish revenue for a period of time, even after they've, got on the boat and left the country.
Yeah.
So would it be right to say that somebody could be, a teacher could be going to Dubai tomorrow and lived there for 3 years and have a zero tax on their salary in Dubai, but owe the Irish revenue money when they come home?
Yeah, really good question and a really common concern. That specific case you gave, no, it's highly unlikely that there's any issue there. The first reason is because, broadly speaking, the employment income is outside the charge to tax, even if they remain ordinarily resident in Ireland. So the specific legislation and reliefs that are designed to prevent Ireland taxing employment income after you've left. And that's a concern. And then a follow-on question, when you're talking to that client is, I'm earning a good salary and I'd like to bring it back with me to Ireland to buy a house. So we navigate that with them and give them the comfort in many cases that is not taxable if they bring it back. So that's something that people need to be aware of.
So they're there in Dubai, they save a load of money when they're there, and in many circumstances they can confidently bring that money home and not expect the Irish revenue to be dipping their hand in their pocket.
Yeah, in most cases. I think
sorry to cut across you, Steph, but in what circumstances should they not be confident?
So perhaps Dubai wouldn't be a scenario where we'd see it too often, but you would sometimes have people presume, and we hear it frequently, that they would perhaps live or be tax resident in the UK, for example, but come to Ireland and work here for the summer, let's say, or for, 4 months of the year, 3 months of the year. So not a sufficient amount of time to become a resident, but a sufficient amount of time that consideration needs to be given to the fact that they have an Irish source of income. So this is an important point. When somebody's physically doing work in Ireland, whether it's because they have their own business or they're an employee of a foreign entity, the income that they earn is considered to be Irish sourced. So if, for example, we take the teacher and they were coming back and maybe they were doing some online grinds or something from Ireland for 3 or 4 months, Consideration would need to be given to the fact that there could be an Irish tax charge in some circumstances. Why? Because the source of the income becomes Irish when the work is physically done here. And this is when we need to kind of go into a little bit more depth with the client. So a common misnomer is, well, I'm not tax resident, so I don't have a tax liability. That's not necessarily how it works. But I think broad stroke, employment income isn't one of the income sources that we get too concerned about when it's nice and black and white. Like you said, you go abroad, you work, you earn your income there. There's a split year relief provided for in the Tax Acts that releases you from an Irish tax charge.
Okay.
And now a quick word on our episode sponsor, Currencies Direct. If you're looking for a fast, easy way to transfer money to or from Ireland without the hassle and cost of dealing with your bank, keep it simple with Currencies Direct. Whether you're buying property or require regular currency transfers, Currencies Direct can help you save money. As a special offer for our listeners, when you use the link in the show notes and quote Expat Taxes when registering with Currencies Direct, you'll receive a €50 one-for-all or Amazon voucher when you transfer €5,000 or more in your first 6 months with Currencies Direct. Registration is quick and easy, and you decide how you transfer 24/7 via their online money transfer service, over the phone with one of their friendly experts, or by using their handy mobile app. Check the show notes or head to currenciesdirect.com to register, and thanks to Currencies Direct for the support of this podcast.
When leaving then, in terms of, and I mean, let's talk about, both people who are just leaving for a new job, let's say, with little or no wealth built up in Ireland at that time. Or indeed people with a load of wealth built up in Ireland who might be leaving because they want to dip their hand in those cookie jars and are afraid of what the tax liabilities in Ireland would be. So what are the biggest issues? If we can focus on the latter there, the people, because they tend to be, the vast majority of people who tune in to us.
Yeah.
You're leaving Ireland, you've built wealth through, let's say, pension funds, a property portfolio, stocks and shares, whatever, and you want to be taxed in the future in a jurisdiction that's a bit friendlier.
Okay. Yeah. So I'll definitely talk about the latter, but just want to add one tiny point. For somebody departing and taking up foreign employment, particularly if they're moving to a jurisdiction where there isn't a social security system, we'd always encourage them to consider whether they might want to make voluntary contributions from a PRSI perspective.
Okay, so that's an option.
That's something to consider. It depends obviously on the age and the cost, etc. But just a nice little sweetener to be aware of if you're going to some of these jurisdictions that don't have social security coverage.
Okay.
So that's one point. For the latter category, you're really looking at a planning exercise, and it's definitely warranted. So for each of the different kind of income and assets you mentioned, there'll be considerations, but let's pick some of the headline ones. There's an anti-avoidance provision in Irish legislation in Section 29A of the Tax Acts that basically is designed to disincentivise people from going outside of Ireland for limited periods of time, 5 years, namely selling an asset while outside the reach of the Irish taxman and then returning to Ireland subsequent.
Okay.
So you would need to have that conversation with the client and make them aware of that. Some of our double tax agreements are actually tweaked to take that provision into account. And, some of the tax-friendly jurisdictions that we have treaties with tend to be in the Middle East. And what we've seen in some recent tax appeal cases is that treaty protection is not as extensive as we would like it to be. What do I mean by that? Well, when you look at the way that the double tax agreement with the UAE, for example, is written, it is quite clear that to be considered a resident of the UAE, you are somebody who is liable to tax there. Now, I don't believe Revenue have been as successful as they'd like to be in this claim, but it does go to show that the line of thinking is you can't rely on a treaty if you're not subject to tax in the jurisdiction, and that is one of the definitions required to offer treaty protection.
Okay.
What does this mean?
Yeah.
It means that if you've got somebody going to the Middle East and they have acquired a portfolio of assets and they're planning to liquidate it, they really need to take tax advice to escape both the ordinary residency tax charge that I mentioned and potentially to be cognizant of how Section 29A might apply in practice to them. So this is an area where sometimes barstool talk can be very dangerous, because John will tell Michael, that he got advice about this, and then there's a conception that this is what applies. It can be very nuanced and specific on the circumstances that we're looking at. And I think particularly when you're considering Ireland as one of the higher taxing jurisdictions in the OECD, you can generally say to somebody, well, you're moving from a high tax jurisdiction to a low one. So taking good advice will pay for itself multiple times over very quickly.
Yes.
And I suppose as well, also from the perspective of scrutiny, you need to be cognizant of the fact that there is cross-border reporting between a lot of jurisdictions about things that are happening. We know now with the Common Reporting Standard and FATCA that reporting does happen. So often clients will say things like, well, how do revenue know? Yeah. And it's not necessarily going to be because you've told them. It could be because an institution that you're banking with has. So this is not scaremongering, these are facts, but I think it just goes to show how sometimes clients can kind of try to get themselves so far, and that's brilliant, but really, working with a professional who can take you that whole way and also understands the importance of providing aligned advice. Often if we're advising somebody who's going outside of Ireland, they've decided they'd like to live elsewhere, there is definitely a need to bring in a foreign tax advisor. And this is another thing that we often find is that, I can completely understand that clients would say, well, I just want to find an advisor who does it all. And when you look under the hood of how complex this can be, you start to realise that's usually a unicorn. There is very few advisors who will advise you comprehensively from beginning to end on one of these transactions, simply because of one of the number of moving parts that are in play.
And so in those circumstances where you're dealing with a client who perhaps needs the foreign advisor, as you say, do you have a kind of network of people around the world that you have worked with that you can bring to the table in that?
We would have about 25 to 30 advisors in different jurisdictions that we would partner with. Some we would work with very frequently. So we actually have a team in the UK that are part of the Expat Taxes brand and network. And they will offer UK advice, do UK tax returns. We have partners in the US, Canada, Australia, the Middle East, South Africa, you name it, Germany, France, Belgium, like the common countries that we see our clients coming to and from.
Right, very good. You mentioned DTAs, double tax agreements there. And when we were talking beforehand, you said there are a number of common fallacies, I think were the words you used, that people believe certain things about DTAs that may not be exactly true. Can you tell us what those common fallacies are? So,
firstly, treaties are designed to avoid double taxation. And that itself can sometimes be a bit of a confusing phrase. That is not the same as that means you only pay tax in one country.
Yes.
That's not how they work.
Yes.
So, clients will often come to us and, the comments that we'll hear, which have an element of truth to them are, well, there should be credit for the tax I paid. Or I already paid tax on that, so Ireland doesn't get to tax it again. And it's really that simple, because when you actually look under, the framework that the OECD has kind of drafted the treaties on, it provides different articles in the treaty, articles being paragraphs or sections that apply to different income and gain types. So normally in a standard treaty, you'll have an article for employment income, interest, dividends, rental income, capital gains, pensions, government pensions, etc., etc. You get the gist. And when you read each of those, you've got to be very clear when you read it as to where the individual is a resident for the purpose of the treaty, where the source of the income comes from, and then also how the credit mechanism works practically. Different treaties. So, for example,
that all sounds very simple indeed.
Very simple. Yeah. Very simple.
Okay, so I mean, all of that, if I'm understanding you correctly, then it's not only about the income itself. In that case, it's about the source of the income. It's about the whether that's a commercial source, whether it's an institutional source, whether it's a governmental source.
Exactly.
Okay. And you said too, when we were talking about that subject, there's a difference between compliance and planning.
Yeah.
So give me some meat on the bones of that one. What do you mean by there's a difference between compliance and planning?
The taxes are a necessary evil, really, aren't they? And they serve such an important function in a society like what we live in. But I'm a big believer in, what do clients want? They want to comply. They want to know that their taxes are in order. But nobody likes to pay more tax than they need to. So how we approach the tax return preparation is we will use it, particularly if a client has come to us, as a way to kind of give them confidence that everything's in order. So are you compliant?
Yeah.
But equally to use it as an opportunity. How can we do better? And a lot of our clients, depending on their tax profile, can arrange their affairs in a way, legitimately, to minimise tax leakage, which obviously is what everybody wants to do. So what does that look like? I mean, basic benign things like telling a client, have you considered making an AVC contribution to your pension scheme up until the end of October, for example? And clients will often go, well, I forgot I could do that. Helping them claim tax credits, or helping them understand that, for example, a certain foreign pension might qualify for a tax credit that maybe a dividend doesn't qualify for. So if we're in a different category of non-domicile clients, we will work with clients to help them understand, well, what makes more sense for us to bring to Ireland in terms of income that we're going to drag into the tax net. So, and then there's a broader piece as well, isn't there, around kind of helping people understand or plan for these major life events.
Yeah.
So people will often say things to us like, but it's just a form. And really, it's more than that, because it's actually representative of where you are on the totem pole in terms of what you owe revenue. But it also should focus your mind on what's happened, what is going to happen, and what's my plan for that. So you need to be having that proactive conversation with your tax advisor.
Yeah, it's funny you say that. You remind me, what I say to people on my consults regularly is that the secret to tax minimisation is about looking into the future and saying what's likely to happen and what can I change today that detaxes those events.
Yeah, exactly.
And that's really, in a paraphrasing, that's a lot of what you're saying there, if I'm reading you correctly. You said too about you mentioned the barroom advisor there, and before we were recording, you said spurious sources, and that people kind of have half truths about either coming to or going away from Ireland. One of the things I often say to people when I'm talking to them myself is there are times when people outgrow the advisors they had when they were younger and poorer and had very different circumstances. That doesn't mean that those advisors tell them when they've outgrown them, because, as I've said before, turkeys don't be voting for Christmas, so, but it sounds to me from what you're saying is that this is a very specialist area, and while the standard accountant might know a bit about this, that if either you're leaving Ireland or coming back to Ireland or coming to Ireland for the first time, really specialist advice is needed in this space, isn't it?
And I'll give you an example of that might resonate with people listening. When you talk about those kind of tax-friendly jurisdictions, what commonly happens, and we've seen it, is that there will be a product sold to the client that is referred to as a pension. And I believe that's very misleading, because generally pensions are tax-efficient products designed to provide for a tax-efficient retirement. But if you don't pay tax, then it's not really a pension. Yeah. And when you actually look at it, a lot of the times it's just an investment product. So clients will come back to Ireland with these and they will keep calling it pension because that's what they were told it was. And it's actually usually nothing like a pension in terms of how Irish Revenue are likely to look at it. It's likely going to have the characteristics of what we would call an offshore fund. So an account that has possible deemed disposal rules, tax profiling that, is not aligned with the majority of the taxpayers we'd work with. And it's not to say that the person who sold you that product had any malice or, ill intent. But I suppose they don't know what they don't know. And the onus is on you as the person paying the premium and expecting to benefit from the product to take the advice in advance. And I think as well, in terms of who you take advice from, you wouldn't go to your GP and ask them to perform a lobotomy, because you understand that that's not where their specialism lies. And this, not to say that our tax is like lobotomy, but the point being
Can
that
feel like that,
it sometimes does, probably as painful. But I think the point I'm trying to make is, use specialists when you're going through these life events. So good tax advice is always warranted for major life events in any setting. It is crucial when you are moving across two tax jurisdictions, and it's even more important when you're moving to a high tax jurisdiction like Ireland, because you don't negotiate with revenue when you're a resident and something's due and payable. You pay it and move on with your life. The consequences are what they are at that point.
You can only change tomorrow, not yesterday.
It's to your point. You plan for this. So, and I think as well, it's sometimes that you feel like you're adding to the mental load. Like, to go back to my point earlier, there's a plethora of things you have to do when you relocate. I would always encourage clients to take advice about 6 months before they move, if possible. It gives us time.
No matter which direction they're going in.
Yeah. It is. You can save people from themselves in that time frame. When somebody approaches you 3 weeks before they come, it's a bit more difficult. That is not to say that there isn't a valid reason to take advice after a move. There is.
Yes.
Sometimes it's damage limitation at that point, but that's not always the case.
Okay. And earlier I asked you about what maybe the contents of a plan to leave should be, in terms of the issues that are facing people who are, sticks up from Ireland going somewhere else. Now let's talk about people coming in the other direction.
Yeah.
So what are the issues facing people either coming home, or indeed, as I've witnessed on my own consuls, people in Vancouver thinking, I might like to live in Ireland because Grandad came from Sligo or whatever.
Yeah, okay, really, really good point. So the majority of our clients would probably fall into that category. A lot of people will be taking tax advice before they physically move to Ireland. Again, we come back to those two concepts, residency and domicile, as being the ones we anchor our discussion on. And I think, for somebody who's born and raised in Ireland, the planning usually centres around the timing of their residency. When are you going to enter the Irish tax net? Again, sometimes a misnomer, but you can be physically living in Ireland but not yet have exceeded the number of days to be considered resident. So that's an important point. Perhaps for a lot of people, and using the example of what you just said there about the individual who had Grandad born in Ireland, we'd be having a conversation with the client about their domicile status. So what is domicile? Well, domicile is a legal concept that's enshrined in tax law. It's essentially a test of where an individual's original permanent home was. And you're deemed to inherit your domicile from your father, presuming you were born in wedlock. So, most of our clients will present with a fact pattern that would suggest they're non-domiciled. That doesn't necessarily change simply because they're coming to live in Ireland. And their tax profile opens up a lot of opportunity to take advantage of the remittance basis of tax. So when we were chatting previously, the UK had a scheme like this previously. Ours was quite close to it. The UK scheme had changed over the years, and they've just done away with it. Ireland retains it, and it is very useful for clients coming here who are non-domiciled. Why is it useful? Well, essentially it means that their foreign income and their foreign capital gains can remain outside the charge to Irish tax. So all of a sudden, when they're terrified and they hear that Ireland is a high taxing jurisdiction, it changes things.
Yes.
But the application and the practical living of the scheme and how it works requires guidance, because it can be complex. We'd have a lot of clients where one spouse is non-domiciled and one spouse is Irish, returning Irish.
Yeah.
So those couples benefit from having a conversation before they come back. And I think what people sometimes don't realise is that if they don't get the proper advice, they'll actually find that both their tax bill in Ireland is higher than it needs to be, and also the cost to prepare the tax return can be higher, because it's complicated. It's complicated, and if you try to DIY it and you get it wrong, it can get complex
expensive,
very quickly.
Very quickly.
Yeah.
So just go back to something you said there, and that's something I've come across quite a lot in consuls. People from overseas where one partner, one spouse is Irish, and one spouse is Canadian, let's say. So the Canadian is, even when they come here, is not domiciled in Ireland. Their domicility, is that right? Remains in Canada at that stage, because, as you said, it came from dad in terms of born in wedlock. So would it be sensible, let's say this couple have joint assets held in Canada, that when they come home, one is non-dom and one is domicile. So some of those assets will be taxable in Ireland because they're in the name of the domiciled individual. Whereas if that individual gave all those assets to his or her spouse before they came home, then those assets would all be non-dom assets. And is that something that comes up?
I think it has come up because there's anti-avoidance to prevent interspousal transfers if it's not done in a careful way. So I think the conversation there really turns on the importance of taking advice, in advance.
Yes.
Because essentially, there's anti-avoidance that would prevent two resident spouses in that circumstance from transferring assets between each other to benefit from.
Sure. But if they're before they're resident, I was thinking
it would definitely be a consideration,
right,
and something that would warrant review. The point I would make is, and this is kind of where sometimes experience comes in, specifically when you're talking about certain jurisdictions, you'd always be cognizant as well about, well, if we do something to be efficient from an Irish tax perspective and obviously subject to review, what are the foreign tax consequences?
Sure.
So this is my point about...
and that's where your partners around the world come in.
The cross-border advice
while it might benefit from an Irish tax perspective,
exactly,
there might be an equal or opposite negative from the local tax perspective, as it were.
And often the conversations we'll have with clients as well will turn on, what do you want? Because, the non-domicile remittance basis of tax is very advantageous if the client has no immediate or upcoming need or desire for the income or gains in Ireland. But if they say to you, well, actually, we think we're going to build a house and we need the money to build a house.
Sure, well then, because that tax efficient treatment, or from an Irish perspective, tax efficient treatment of the non-dom assets is only based on those assets that stay outside of Ireland, isn't that right?
Exactly.
So if they're bringing them in here to build a house, then it's a moot conversation anyway, certainly around that
and I
percentage
think
of the asset.
This is a cautionary tale as well, because there's exceptions to that. Of course, like everything in tax. And if we go back to my point there about the pension product, which I don't view as a pension product, that's been sold to somebody, it's quite likely that doesn't qualify for the remittance basis. There's a specific out for an asset that is an offshore fund in a certain jurisdiction, that if somebody was to sell that, the gain would be taxable in Ireland. And perhaps most crucially, the 8-year deemed exit event can arise.
Right.
That doesn't get remittance basis. So this is the type of, you kind of don't want to be so sharp you cut yourself. We do a portfolio review. What have you got that we don't like before we start to talk about how the remittance basis might apply? And then you start to understand from the client, what are your plans? What do we want to do?
And earlier you said to me too about, and I think in a way you're talking a little bit about this now, is the cost benefit analysis. I think you were telling me a story about somebody who might be moving abroad. Tell me that story again, please.
So this would come up from time to time, where people will very rightly identify that if, perhaps one partner is working abroad, perhaps in a low tax jurisdiction, being paid very well, that the family could live apart for a period of time. The individual would break their Irish residency and their employment income would be outside the Irish tax net. That would then give them the opportunity to potentially bring that money back to Ireland without there being an Irish tax charge. So obviously it's very fact specific. But what we were saying earlier, and we've seen lived examples of this, is that sometimes clients can become very excited about a tax saving. And of course, our job is to help them understand what that looks like. My personal approach is to quantify what that figure might be, because we have to marry that against the lifestyle cost of, in that example, having perhaps one partner in Ireland with young children and a partner outside of Ireland who is, if they're trying to remain non-resident, limited in terms of the amount of time they can actually be here, which probably looks like missed family events, foreign family holidays, lots of things that might not align with the stage of life that they're at.
Yes.
So, our job as tax advisors is to be very specific and clear on what the tax law says, and then to guide the client on how that is going to be for them as a lived experience. And I often love saying to clients in a consult, particularly when someone's coming back to Ireland, we'll just do a very brief tax estimate. What do we think your Irish tax bill is going to look like? Because people myopically can do a bit of research and they go, oh, it's going to be terrible.
It's going to be huge, yeah.
And it doesn't have to be.
Yeah.
But it's just, I often find, even personally, we worry about the unknown. But once somebody brings certainty and a quantum to what we're worried about, it tends to kind of not be as bad as we think it's going to be. Or
as good.
Exactly. Or equally not worth it.
Yeah.
When you're going the other direction.
So you're not going to be able to see your kids grow up, but you're going to save yourself 100 grand in tax over 5 years, for example.
Yeah.
The question then is 20 grand a year worth giving up watching your kids grow up.
That's exactly it. That measure. And that's very much a personal decision. But I think, as advisors, we need to be very clear that we shouldn't get lost in jargon or technical talk, because it intimidates people when they're already stressed. You break it down into easy to understand, make it real for me. What does that mean for me?
Yeah, and also I think, I'm wholeheartedly agreeing with you here. Just because you can save a few bob on tax doesn't mean you should. Mm. Because there is always a sacrifice, isn't there, of in some shape or form. To make that saving. And that's where, I have a problem with a lot of so-called advisors out there, whether in the tax world or other financial disciplines, is they're focused on delivering one outcome. So I'm going to tell you how to pay less tax, but forget about the ripple effect of that shade, whether that's the personal ripple effect, like not being able to see your kids grow up, or indeed it means that, okay, you save a few bob now, but you pay a whole lot of tax in 5 years' time that you wouldn't have paid. So I think, I think that a lot of advisors fail to recognise the humanity of their clients.
Yeah.
And break it down into pure euro and cent terms.
And I think you kind of, what clients will often say back to us, at the end of a consultation is, we're so relieved, we were so confused, and really that's what you're being paid to do, is to take away the confusion, take away the stress, give them back time and money, because they're the finite resources.
You said about people worrying. I mean, there's. I think it's a broadly accepted fact that 90% of what we worry about never happens.
Exactly.
So stop worrying, to get the advice and make sure that you walk into a decision to come to Ireland, to leave Ireland, come back to Ireland after you left a while ago, that you make that with your eyes wide open, that you understand the ramifications of it, and you understand the financial impact, which is just one of the things that is relevant,
Exactly.
Well, look, I mean, that's been brilliant. I mean, I think, while I said to you before we started recording that 96% of our audience are Irish, are based in Ireland, indeed, many of them, I hope, listening to this, will be contemplating leaving. Many of them will know people who've already left who are contemplating coming home. And then even some of them amongst the 4% might be people listening to us in far-flung areas and thinking of moving to Ireland. So for today, Steph, thank you very much for coming in. I've been delighted to meet you. I think, there's no doubt you're providing a service that will resonate with many viewers. And, I also have no doubt we'll get a bunch of questions now that I didn't ask you. So we might ask you back again another day to answer those questions.
Of course, feel free to send them on to us. We'll do
our
best.
Well, for now, Steph, thanks a lot for today.
Thank you.
Thanks for listening to Tax Bites for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.